Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Burlington Stores Inc. Annual Report. Burlington Stores Inc. offers a wide range of businesses and services through its retail operations. At the core of its offerings are fashion-focused merchandise, including women's ready-to-wear apparel, menswear, youth apparel, footwear, accessories, home furnishings, toys, gifts, coats, baby products, and beauty merchandise. The company operates under two brands, Burlington Stores and Coho's Fashions, catering to customers in the United States and Puerto Rico. Its extensive product line caters to diverse customer needs, making it a one-stop destination for various shopping requirements. Burlington Stores, Inc. market capitalization of $20 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Burlington Stores, Inc. holds a significant advantage in their industry. Burlington Stores, Inc. trades at a higher price-to-earnings ratio of 33 times and a higher price-to-book ratio of 10.65 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 84% of total assets. This elevated debt level warrants heightened caution, as it may limit the company financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline are multifaceted, reflecting both internal and external factors. On the growth side, expanding store footprint, innovative security solutions, improved supply chain capabilities, targeted advertising, and increased sales from new and comparable stores have all contributed to revenue expansion. These efforts have yielded significant results, with net sales from new stores and non-comparable stores increasing by $691.4 million. However, external factors have also played a crucial role in shaping revenue growth or decline. Prolonged inflationary pressures, economic slowdowns, high unemployment rates, and uncertain economic outlooks have all negatively impacted discretionary spending among low-income shoppers, leading to revenue declines. Additionally, impairment charges related to long-lived assets and store closures have further contributed to revenue shortfalls. In summary, the primary drivers of revenue growth or decline are a complex interplay between internal initiatives aimed at improving operational efficiency and external factors influencing consumer behavior and economic conditions. The net income of the company has experienced fluctuations over the past few years. In fiscal 2024, it increased by $163,700,000 compared to fiscal 2023, marking a significant 48.1% growth. However, in fiscal 2025, it decreased by -$24,266,000, resulting in a 4.8% decline from the previous year. Conversely, in fiscal 2026, net income increased by $106,514,000, representing a 21.2% rise over fiscal 2025. The profit margins have also undergone changes. In fiscal 2023, the adjusted EBIT margin was 261.6%, which increased to 170.8% in fiscal 2024. However, it decreased to 148.1% in fiscal 2025. The reasons behind these fluctuations are multifaceted. Increased sales and gross margin rates have contributed positively, but higher labor costs, disruptions in merchandise supply, and reduced sales volumes have had a negative impact on net income. Additionally, increased costs from terminating leases or assigning/subleasing space, as well as purchasing merchandise at non-competitive prices, have affected profit margins. Based on the extracted summaries, it is evident that the company is indeed generating positive operating cash flow. The data from page 36 confirms this, stating that the company is producing a positive operating cash flow. Further evidence can be found in page 49, where the net cash provided by operating activities for both fiscal year ended January 31, 2026 and fiscal year ended February 1, 2025 are reported as $1,231,382 and $863,376 respectively. These figures indicate a consistent trend of positive operating cash flow over the past 2 years. In conclusion, the available data suggests that the company is successfully generating positive operating cash flow, which is a crucial indicator of its financial health and stability. The company's debt level has undergone significant changes over the past few years. Initially, the debt level increased from $933 million to $1,719.4 million due to refinancing and incremental term loans. This increase was further amplified by a rise in debt obligations of $1,642,981,000 compared to previous periods. The company also refinanced its $933 million term B-6 loans with term B-7 loans in an aggregate principal amount of $1,250 million. However, the total debt has increased by only $327.6 million from $1,898.5 million to $2,181.8 million, indicating a slight slowdown in debt accumulation. In terms of interest expenses, there is no significant change observed over the past few years. The estimated cash required to make interest payments for the fiscal year ending January 30, 2027, is approximately $93.2 million, which is relatively consistent with previous year's interest expenses. For instance, the interest expense for fiscal 2026 was $71,041,000, while it was $69,522,000 in fiscal 2025 and $78,399,000 in fiscal 2024. The interest expenses on convertible notes have also remained relatively stable, with a slight decrease from $10,875,000 in FYE Feb 3, 2024 to $5,815,000 in FYE Jan 31, 2026. Management is optimistic about the company's outlook, with a focus on both short-term and long-term goals. In the short term, they aim to open approximately 110 net new stores during fiscal 2026 while continuing to grow their merchandising talent base and deliver a consistent shopping experience. In terms of long-term strategy, management plans to expand the store footprint in attractive locations, targeting 2,000 stores over time. They also intend to invest in supply chain capabilities to support growth and improve operational efficiency. Key strategies include chasing sales trends by purchasing merchandise in season and opportunistically, delivering compelling value while remaining responsive to evolving customer preferences, and building a strong reputation with consumers through marketing efforts. Management is aware of potential risks, including changes in tariff policy and fluctuations in financial performance. They plan to monitor these factors closely and adjust their strategies accordingly. Overall, management's outlook is focused on growth, expansion, and delivering value to customers while navigating potential challenges. The company has made significant moves in its business operations through acquisitions and divestitures. In terms of acquisitions, the most notable transaction was the purchase of 178 acres of land in Buckeye, Arizona for $50.6 million. This acquisition is expected to provide the company with a substantial amount of land for future development. On the other hand, the company has also engaged in divestitures as part of its strategy to optimize its operations and reduce costs. One notable example is the exchange agreements made with holders of 2027 convertible notes. Additionally, the company has been downsizing existing stores to incorporate new store designs and reduce occupancy costs, which can be seen as an implied divestiture of underperforming locations. These moves are expected to have a positive impact on the company's bottom line and overall performance. The company's financial activities have been notable in recent years. One significant development is the payment of dividends to shareholders. According to the provided information, the company has indeed paid dividends, as stated on page 22. In addition to paying dividends, the company has also engaged in share buybacks. Under its share repurchase program, the company repurchased a substantial number of shares in fiscal 2025. Specifically, it bought back 985,594 shares for $251.4 million. This indicates that the company is committed to returning value to its shareholders through both dividend payments and strategic share purchases. Concerns about inventory buildup or supply chain disruption are evident throughout the provided text. One major concern is the potential for excess inventory to have a material adverse effect on financial condition and results of operations, page 7. This can lead to decreased gross profits and net income due to markdowns, as well as negatively impact performance and reputation if customer demand is not met. The risk of supply chain disruptions is further exacerbated by factors outside of control, such as natural disasters, epidemics or pandemics, political instability, labor issues, reduced freight capacity, and increasing cost of regulations, page 9. Additionally, vendors can change terms or discontinue selling to the company at any time without contractual assurances, potentially reducing high-quality merchandise availability, page 10. The use of temporary personnel during busy periods may also be inadequate, leading to further supply chain disruptions, page 11. Natural disasters and industrial accidents could curtail production and disrupt supplies, while increases in labor and production costs in goods-producing countries would result in an increase in inventory costs, page 12. Furthermore, the current economic environment has caused an increase in inventory shrinkage, with supply chain disruptions being one of the contributing factors, page 15. Inventory buildup is also a concern, with a $61.1 million increase from February 1, 2025 to January 31, 2026, page 33, and purchase commitments related to goods that were not received totaling $1,774 million as of January 31, 2026, page 81. These concerns highlight the need for careful management of inventory levels and supply chains to mitigate potential disruptions. That concludes the financial summary for Burlington Stores Inc. Feel free to comment below, and I will be happy to answer them when possible.